Welcome to Strategic Equity Management's second quarter economic outlook. My name is Jeff Hybeck. I'm the Senior Portfolio Manager for Strategic Equity. And what we wanted to cover today is the key question everybody is asking after such a great first quarter is what can we expect the rest of 2012? Before we get too far into it, I want to go over a quick disclaimer here. Any of the comments that you hear in today's broadcast should not be considered investment recommendations. Investing in the stock or bond markets definitely involves risk, and it may not be suitable for all investors. Before making any investment decision, you should carefully consider your investment objective, level of experience, and your risk appetite. There definitely is a possibility that you could sustain a loss of some or all of your initial investments in the markets, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with your investments and seek advice from an independent financial advisor if you have any doubts. All investments involve these risks, including those managed by Strategic Equity. We do have to say that past performance is not a guarantee of future results. Strategic Equity is registered with the SEC, and our Form ADV Part 2 is available upon request. Before we can look at what the rest of 2012 may bring, I thought it would be interesting to take a look back at the outlook that we gave at the beginning of the year in our last economic update. We identified 5 things on each side of the ledger that could either make it a great year or a very tough year. Number 1 on the good side was the economic recovery could pick up steam. Certainly no surprises out of Washington. We needed to see strong earnings growth. European leaders implementing more than just band-aids like they did in 2011, and continued easy money policies from the Fed. Now on the downside in our outlook, we were looking at things such as the expectations for the year, both the stock market and the economy, could be too optimistic. The fact that it could be too late to save many European countries and their banks. The problem that easy money could cause runaway inflation like we saw the last 2 years. No stimulus from Congress, plus we have that uncertainty on tax rates. And finally, the ugly election year rhetoric. Now, one thing I noticed as we watched the market during the first quarter was with such a strong performance out of the market, you started to ask yourself, well, how many of these things on the good side of the ledger have already been priced into the market? Now, certainly, the economic recovery did pick up steam, although the last couple economic reports showed a little bit of wavering, but we'll talk about in a minute where we see the economic recovery. But so far, we still have that on the positive side. We haven't seen any surprises out of Washington yet. We got the payroll tax cut extended till the end of the year, as well as unemployment benefits. If you look at every piece of legislation, it looks like if the House approves it, the Senate's not going to vote on it. And if the Senate approves it, the House is going to strike it down. So we probably won't see any surprises yet out of Washington. Again, earnings season has started already, and we're continuing to see strong earnings growth. So there's already 3 check marks still in the market's favor for the rest of the year. Now, as you've seen, if you've watched the market the last few days, and as well as a few weeks in March, the question mark on what the European leaders are going to do has certainly emerged. And it appears that even the solutions they proposed late last year with some of the refinancing operations are nothing more than band-aids, because already we're seeing Spain run into some difficulties with it, and they just had the solution put in, what, 3-4 months ago. And then we saw some pretty wild swings both in March and so far in April as the market wrestles with some commentary out of the Federal Reserve. Now, we have some people saying that they need to continue to stimulate the economy via whatever solutions they come up with, and then we have others saying the Fed's done enough. So that is a big question mark, and something that we've pointed out several times is when the market's rallied, it's been during the times where the Federal Reserve or the European Central Bank has been making money easily available. And the times that the market has struggled the last 3 years have been times where a certain plan had already expired. You know, we've heard a lot about quantitative easing. Well, they've done 2 rounds of that. We've seen things out of European central banks. So the market seems to stall out once those programs end. And as we'll show in a minute, the economic recovery is already starting to wane a little bit, despite all that money that has flown into the market. Now, over on the tough part of the ledger, it's hard to say what the market's expectations are. We still see a lot of people saying that it's going to be a great year. We're going to see, you know, some people are mentioning 1,500 on the S&P 500. So we still have some pretty optimistic expectations, but I have seen the sentiment the last couple of weeks fall off a little bit. So that's why I left a question mark in that field. As far as it being too late to save many European countries and banks, I think, you know, they're going to have to bail out Spain, and then the question becomes, do they have enough money to bail out Spain? And then, of course, the question of who's next, and what's going to be the damage. And we keep seeing this philosophy over in Europe to take money from the private sector, the risks that the private sector took, and then putting it on the public sector's balance sheet. And that means the taxpayers have to pay for it. So it's a big question mark, and something that could be looming over the market the rest of 2012. Inflation, we saw oil prices and gasoline prices again spike up. They've come down just a little bit, but what we've seen the last 3 years is this springtime season, a big boost in oil prices, and the oil prices don't really start falling significantly until after the Fed's program ends, and they have a program that where they're creating more money and trying to stimulate the markets through interest rates expires in June. So it's a question of what's going to happen with inflation for the next couple of months. Now, the biggest issue, I think, for the market, and this is the same thing I said in January, there are a lot of problems looming at the end of this year. You look at every single tax cut that was put in since 2001 is set to expire in 2013. So that means by January 1st, they have to have a solution, or everybody's going to see the withholding taxes on their paychecks go up significantly. We also have what they call the spending cuts that have been agreed upon last summer when they agreed to raise the debt ceiling. Those kick in beginning in January. And speaking of the debt ceiling, it's looking at the rate they're spending money. We may have to deal with the debt ceiling once again before the election season. For sure, we'll have to deal with it sometime before the end of the year. So that, as we learned last summer, could be a very difficult time for the market. And then, speaking of the election, the rhetoric has already started. It looks like it's going to be Mitt Romney against Barack Obama, and they're already starting to go after each other. And what I really worry about is too much bashing of Wall Street, especially because Mitt Romney is so tied to Wall Street. We could see a lot of rhetoric coming out of the White House and some of the Democrats in Congress about Wall Street. And every time they've bashed Wall Street, we've seen the market sell off quite a bit. But it's still, I think, despite Europe, it's all about the economy. And I updated my leading economic recovery indicators to show where we have positives and where we have negatives. And I showed at the beginning of the year how building permits were growing at a very good pace, over 20%. Well, that's actually accelerated the first 3 months. And now through March, we see year-over-year growth rate in building permits at 30%. Housing starts are growing 10 to 15%. So we're seeing that part of the economy do really well. We're seeing improving consumer confidence. Stock prices are definitely making people feel more wealthy. Hours worked have ticked up a little bit. The jobs market still is slowly improving, as is capacity utilization. Now, just like we showed at the beginning of the year, some of the more important leading indicators that signaled the end of the recession are slowing or decelerating, and that includes consumer goods orders, business activity, and vendor performance, which are all manufacturing type indicators showing that the growth we've seen there is definitely slow. They're still helping the economy along, but not at a fast enough pace to save the economy. So it's going to depend a lot on housing and jobs for the rest of 2012, which matches my outlook from January. What is really nice to see when you look at housing is there's definite signs of life. If you look at this chart, again, it's still a pretty low number when you look at where we were at. You know, we were at almost 2,300 building permits on an annualized basis, and now we're barely over 700 based on the last report. But as you can see, it's the highest it's been during this entire recovery process. What's more important, though, to the economy is the rate of growth. And as we mentioned, they're growing at a rate of over 30%. And what that means is we're seeing 30% more activity than we saw a year ago. So that means the potential for economic growth is definitely there. And that's something that does make me excited about it. I mentioned it during our January update. In Tucson, you're seeing all sorts of building projects going on, and that's putting people to work. It's getting people to spend money on materials, and that's employing people. And so we are certainly seeing signs of life in the construction industry in Tucson and all of the Sun Belt states, but also across the nation. I thought I saw Denver is one of the hottest real estate markets right now in the country. And so it's certainly spreading, and that could help save the economy throughout the rest of 2012. I mentioned this during our January update. You could kind of see the bubble in building permits. I took the long-term average growth rate, and we're finally back to that trend. So that doesn't mean we can't continue a little bit lower, but the bubble at least has been taken care of via this big drop we saw in building activity. And again, my favorite chart as far as why I look at the housing market as the key driver of the economy. You can kind of see how the blue line, which is housing starts, tends to pull the economy in whatever direction it's heading. The other important indicator, though, is the jobs market, and it is increasing ever so slightly. It's, you know, I try to paint a rosy picture on jobs. The March jobs report was very ugly indeed. About half as many jobs as people were expecting were created in March. However, we still have more jobs than we had a year ago, and that's a positive sign. But as I point out quite often, we still have a long way to go. Just if we continue the current average monthly gains, which is over 200,000 over the last 3 months, a very nice clip. It's still going to take until 2014 just to get back to the level of employment we were at when the economy peaked. So that is something that is a bit of a concern for the big picture economic outlook. Speaking of big picture problems, this is the definition of big picture. And what it is, it's a chart that I put together back in the early 2000s that was just simply looking at the 18-year cycles that the market seemed to go with. And as I did more research, I found that it tied in nicely with the demographic cycles and some of the social cycles that other researchers have looked at. And one thing that's really interesting is the way it repeats. If you think about it, every generation has control of the economy via business leadership, their earnings, and the government for about 18 to 22 years. Now, some will have it longer, some will have it less, but in general, that's about the average length of time. And what's very interesting is if you walk through the different periods of time here, you have the unraveling from 1911 to 1928. And I think, you know, think of the Roaring Twenties and everything that happened. And the whole fiber of America was beginning to unravel at that time. And then, of course, that was followed by a major crisis during the Depression and World War II. But then we had a period of economic highs. America really became a superpower during that time frame, and that was a good time to be a stock market investor. But following that, when we had the social awakening in the 60s and 70s, that was an awful time to be a buy and hold investor. But then that went into the time when the baby boomers really took over, that period from 1983 to 2000. They were at peak earnings. They were spending money like crazy. They were going into debt like crazy, helping to fuel some of the economic growth. But they were also investing in the market very heavily. Now, what we have to do, just like the past unraveling, is we have to pay for some of the bad growth that we saw. Now, there were some good things that happened in the 80s and 90s, but there was also some bad things, and the main bad thing that we had was debt. And that's been the main issue during this entire crisis. And we're 12 years into at least an 18-year secular bear market, and the market really hasn't gone anywhere during that time. And we don't know if it's going to last another 6 years. We don't know if it's going to be 8, 10, 12 years. What we do know is all the solutions that have been given so far have only masked the underlying symptoms. And that symptom, again, is too much debt, both in our country and around the world. So what we've done at Strategic Equity is, over the last 20 years, is we've deployed what we call active money management that's designed to play defense. And when you get into those difficult times, we know how uncomfortable it is to ride the market all the way down. Well, our goal won't always be perfect, but our goal is to get out of the market at a point when it looks like it's going to continue much lower. And we'll still have some losses here and there. It also means that we're not going to capture all of the upside when the market shoots up 12%, because we do play defense. We're very rarely fully invested in the stock market. We tell people the only way to get the stock market's gains is to fully invest in the stock market. And that's something that we've learned in our 20 years, that people like the stock market when it's going up, but they get very uncomfortable when it's going down. So what we want to do at all times is give people something they can stick with, something that's not going to shoot the lights out on the upside, but it's also probably not going to shoot yourself in the foot and destroy your retirement plans. We've covered a lot of data today. I do write a daily blog. If you haven't been on our website, that website is stratequity.com. Once you're there, you can either, if you're a industry professional, you could click on the link there, or where it says investors. Doesn't mean you have to be an investor with SEM. All it means is that you're an individual investor wanting to find out more information about the markets and getting access to our daily blog. Once you've registered and confirmed that you are indeed a human being and not a robot trying to spam our site, you log back in, and off to the right there will be something that says Trading Desk Updates. And from there you can click in, see what I'm seeing from our trading desk. We try to do these quarterly economic calls, but we also, on a daily basis, look at the economy, we look at the news driving the markets, we look at corporate earnings, as well as how our stock market and bond market trading programs are adapting to the current environment. So again, if you want to find out more information, go ahead and go to our website. I really want to thank everybody for joining us today. I hope to be back next quarter with another economic update. I hope it's another rosy one where we continue to see economic growth. But as I said before, we got to deal with Europe. We got to deal with some of these tax issues that are coming up at the end of the year. So stay tuned. Thanks for joining us, and have a great day.